I think the market's what, 30 trillion today. $20,000 gold is going to be worth officially 5 trillion, right? So that's, but if you look at the treasury market, and I don't know these now, I want to say the 5 trillion probably takes you, it's probably 100% of everything over at least 7 years and maybe over 5 years. And you can buy it all back. And then, you know, you want to reissue it bills, you want to resize that, however you want to do that, you can certainly do that. But it's a paradox. You would think that with inflation ripping and gold at 20,000, as you know, gold at 20,000, inflation ripping in the short run, it would be terrible, but you're basically restructuring it on the other side. You're going to have lower yields.
Sovereign balance sheets are sliding into an inescapable debt spiral as interest expenses outpace fiscal tax revenues. Western nations face severe monetary bottlenecks with virtually no traditional policy tools left to avert systemic default. Lukegromen, a prominent macroeconomic analyst, financial researcher, and founder of FFTT, LLC, projects that the United States will escape this fiscal trap by revaluing its official gold reserves up to $20,000 per ounce. He further predicts this reset will spark heavy nominal inflation, lower long-term yields down to 2 to 3%, and propel the Dow Jones Industrial Average from 50,000 to 100,000 alongside explosive corporate earnings. Under Federal Reserve accounting provisions, repricing the nation's 261 million ounces of bullion injects $5 trillion in cash directly into the Treasury General Account. This liquidity windfall allows monetary authorities to retire sovereign debt maturing beyond 5 to 7 years. Now, we present the clips from Lukegromen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If you go to the Federal Reserve manual for financial accounting manual, for Federal Reserve banks, it's a public document. It's published at least once a year. Section 2.10 says that the gold is held at 42. The Treasury Secretary, at his sole discretion, can instruct the Fed to revalue it. It's basically, and by revaluing it from 42 to whatever that market price is, which you could get it up there. I could get it up there, I think, especially if the Chinese are on board, which I think they would be. And that mechanically creates a deposit of cash into the Treasury General Account at the Fed. It's basically just debit gold, credit cash, right? So it's, you know, you're increasing the value from 42 to 20,000. You have to have an offsetting journal entry. It's 261 million ounces times 4,000. Every $4,000 is roughly $1 trillion. And so 20,000 up from here, from 42, that's basically 5 fours. So 5 fours. So 5 trillion, right? If every 4,000 is $1 trillion, 5 of those is 5 trillion. It just mechanically gets deposited into the TGA. That might be one of their only ways out of this, actually. Now that we're into this period where your interest and interest-like obligations are growing nearly twice your receipts, and your receipts are inflated by AI, which isn't going to keep bubbling forever.
Luke, when you said I do it in a month, I was like, okay, I'm going to challenge Luke, because how can he do 1946 to 1951 in a month? But I see you're taking to the next level.
I could do it in a month. I mean, look, we are now at the point where there are no pleasant ways out of this. You know, we are now into dancing along the edge of a debt spiral, and it's the entire West. And, China ain't going to end up great in that outcome either. So once you get to here, the Overton window of possibilities starts to blow out immensely, right? In terms of policy options. This is a policy option, and it would work. I mean, inflation's in the cake. Like, don't kid yourself. We're going to hear every apologist on X telling us this isn't money printing and it's not inflationary, and it's bullshit. You're taking long end bonds and you're moving them to the front end, and you're going to cut rates. That's inflationary. You are money financing stuff. Stop. Don't lie to people. It's inflationary. I said this to you at the end of maybe not last time, but 2 times ago, where you asked me what yield would you buy 10 years at, and I said no yield. It's not about the yield. It's about the price of the dollar. At $20,000 gold, I would buy 10-year paper at
right. Yeah, I remember that.
And it's fascinating. I mean, we're watching in real time. The more the yuan collapses against gold, and it has collapsed. Everyone's been waiting for it to collapse against the dollar. The yuan's collapsed against gold. What's happened to Chinese yields? Down, 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 down.
Mhm.
At the right price of gold, you're basically going to have a gold collateralized de facto treasury market. And in a gold collateralized bond, and Judy Shelton's work has done a lot of groundwork around this, and 2% interest rates for the long term, if it's gold collateralized, maybe 3. That's the part people are missing. Gold at a high enough rate doesn't destroy the treasury market, it collateralizes it. Now, on a real value, yeah, it's a restructuring, no question. But these people need to be restructured. It's an insolvent market.
And there's enough gold at $20,000 gold. There's enough gold to back the treasury market.
No. I think the market's what, 30 trillion today.
Yeah,
$20,000 gold is going to be worth officially 5 trillion, right? So but if you look at the treasury market, and I don't know these now, I want to say the 5 trillion probably takes you, it's probably 100% of everything over at least 7 years and maybe over 5 years. And you can buy it all back. And then, you want to reissue it bills, you want to resize that, however you want to do that, you can certainly do that. But it's a paradox. You would think that with inflation ripping and gold at 20,000, as gold at 20,000, inflation ripping in the short run, it would be terrible, but you're basically restructuring it on the other side. You're going to have lower yields. You would need some sort of agreement where the problem with gold is when you peg it to a currency.
Okay, so you're not suggesting a peg.
No, not at all.
Okay, got it.
No.
Yeah, I'm with you.
No. What you would do is essentially you're going to settle in gold now, right? And I think that you would probably have some sort of agreement where you would say, look, if you're going to peg anything to anything, you're going to peg gold to oil at 1,000 barrels an ounce. And oil doesn't move a lot, right? So, or say 500 for easy math. $40,000 gold, $800 or $80 oil, excuse me. And that you could do something like that. You could, you don't have to do this through Besant. You could do this through agreement between China, Russia, and the Arabs. Hey, we're going to sit down. We're going to do a conference, and from now on, oil or gold is 500 barrels for an ounce of gold, and we will have devalued oil, which backed the dollar for 50 years de facto, against gold, which backed the dollar for pretty much the rest of American history. And in so doing, we will have created an economic market-based incentive. Now, if America wants to have a lot of oil for national security reasons, great. We all know we need $70, $80. Maybe we need $60, right? We can't do less than 60. Okay, 60, 500, boom, 30,000. You got to have $30,000 gold. So the whole exorbitant privilege goes away. We can't print dollars for oil anymore. That's fine. The Chinese, they want cheap oil because they don't have any oil. Not enough, certainly, right? As we've all been, they don't have nearly enough oil relative to what they consume. Great, they need cheap oil. That's fine. But if you have cheap oil, then you have cheap gold. And so cheap gold in yuan, expensive gold in dollar, what's going to happen to the currency? Yuan's going to strengthen a lot against the dollar. China's ability to be mercantilist will also be hamstrung or limited by that arrangement, by pegging gold or oil to gold. The Europeans, same thing. Hey, we don't have really oil resources, and so we need to incentivize EV. So we want relatively expensive oil. So EVs make sense. Okay, 100 barrel, 100 euro, boom, 50,000 euro gold. I think that is ultimately where we'll end up. I don't know if we'll end up there without a war or not, or if we'll end up there. But that's another way you could do it. And then if we did it that way, then boom, then you can revalue the gold using that. That probably requires some sort of international agreement, probably just between the U.S. and China and a couple of the Arab countries. It would be more than enough. Strong arm everybody else.
A structural reset in the international monetary architecture could bypass the dollar by establishing a direct commodity link between physical bullion and crude oil. A multilateral accord among the United States, China, and Middle Eastern producers could fix crude at 500 barrels per ounce of gold. Setting oil between $60 and $80 per barrel systematically revalues gold toward $30,000 to $40,000 per ounce. This pricing dynamic ends America's exorbitant currency privilege while curbing mercantilist trade advantages by forcing the Chinese yuan to appreciate against the dollar. Rather than destabilizing sovereign paper, high bullion valuations provide tangible backing for public debt, anchoring borrowing costs and securing critical trade corridors. Now, let's get back to the interview.
Gold's price rallying so much to make it the biggest part of reserves is the whole point. That's the whole point. Right? In the same way that you don't say, hey, I have this many shares of S&P in your 401k. What do you say? What's my 401k is worth this in dollars?
True.
So gold's back in the system. And so when you're back in the system as a reserve, when it rains, you got to sell. And so you can see gold was sold. Treasury bonds were sold. Both were sold by some parties. Now, China, who is supposed to be being choked out of oil and, their economy falling apart, did sort of the old take and bid it, hey, gold's down. Great. Give me 10 tons this month. Next month, 12 tons. Next month, 14 tons. Next month, 19 tons. Next month, 26 tons. Just waving it in. So, and not everybody, but yeah, central banks overall sold gold. A bunch of central banks sold gold. Central banks bought by just like a little bit on a net basis in the calendar first quarter. But in the calendar second quarter, gold buying went back to basically all-time highs by central banks. So I think that's why gold got sold off, was exactly people sold it because they needed dollars or they needed oil. And that also is a support for gold's now back in the system. And by the way, it worked. Notice nobody needed to do gold swap lines. Nobody needed to intervene in the yen because people were selling too much gold. It just worked. And they didn't need Bessent's permission to sell gold, like U.S. allies need reportedly permission to sell treasuries. You don't need the banking pipelines to sell your gold. Unlike, look, I like Bitcoin long term, but Bessent's been talking about controlling the pipelines and the on and off ramps to this. And purists know you don't need on and off ramps for Bitcoin. But I think probably at sovereign levels, that's a bit much. But the gold is pretty easy to see, and you don't need anybody's permission. So gold did what it was supposed to do in the war. If gold is moving back into the system, if gold is now a more important FX reserve than treasuries are, which it is. That's just a fact now. And I think they're only going to get more important going forward with all the actions the U.S. are taking, which are effectively communicating that treasuries are only good for certain things if we say so at certain times. And oh, by the way, we're going to be managing the yield curve to erode the real value of your treasury holdings. If I'm a sovereign, I'm just saying, all right, fine, I'm done. I'll buy whatever, just gold. So say gold goes to, I don't know, let's take it at 20,000 for easy math. Yeah. The TGA deposit is going to create $4 trillion. That coin trick, 4 trillion into the TGA. Now I'm Bessent, I can buy back everything in cash beyond probably 5 years. Then I roll out the Clarity Act and stick the rest of it into stable coins. And then my last little special surprise for everybody is, hey, a stable coin T-bill doesn't yield 3.5, yields 60 basis points. Have a good day. Done. Now, who wins, who loses? Treasury holders get killed. Inflation goes nuts. Wages go nuts. Nominal GDP growth goes nuts. Great. That's what we need. Who holds all the bonds? Banks, who got bailed out and never paid for it, really. Boomers, who are the richest generation in history and are consuming 80% of the budget and not paying for it. You just paid for it, guys. Thank you for your donation. Thank you for your service. It's that easy. Now, politically, you're going to have inflation. You're going to lose the midterms. But it's easy mechanical fix. It's like the easiest thing in the world. Stock market goes nuts, by the way. Nuts. Dow probably goes from 50,000 to 100,000. Corporate earnings go nuts. Hiring goes nuts. The debt's the problem.
Global central bank reserve management has reached a historic turning point as official bullion accumulation outpaces traditional foreign exchange holdings. Physical gold functions entirely independent of central issuers, counterparty risk, and permissioned banking infrastructure, enabling sovereign entities to settle deficits without clearance from foreign monetary authorities. Deploying gold recapitalization alongside regulatory frameworks for stablecoins yielding a mere 60 basis points completely reshapes domestic capital distribution, Fixed income bondholders and commercial banking institutions bear the full cost of purchasing power erosion as real asset prices expand. Repricing physical bullion represents an immediate accounting resolution to excessive sovereign liabilities, neutralizing unsustainable debt burdens through deliberate currency restructuring. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.